Hey again, Crystal here, CPA at Life Accounting, where we help you save on taxes and increase your wealth. Today, I'm going to help you do this by going over how a family LLC or a family management company can help you reduce your family's taxable liability and protect your family's assets. If you work in a family-owned business or do business with family members, whether it's your spouse, children, siblings, and so on, then stick around for this full video to learn more about how you can structure your business to reap the tax benefits and asset protection. And if you don't want to miss out on more videos on more ways to save and make money, then make sure to subscribe to our channel. All right, so why should you structure your business as a family LLC or family management company? People choose to do this for one of many reasons. For one, they want to shift taxable income to their family members in lower tax brackets. Or two, they want to reduce estate taxes and pass on more wealth to their children when they die. Or three, they want to protect their family's assets. Or maybe four, they just want to promote entrepreneurship in their family. So let's start by discussing what I mean by shifting taxable income to other family members. Normally, if you have your own business, all of the profits in your business are passed to you individually, and you pay taxes on that income. And after your taxes are paid, that's when you spend money on personal items like your mortgage, food, bills, and of course, your kids. But what if you could shift some of your business income to your kids before you pay taxes on it and use that money for their care? What if you did that and now your taxable income is lower and you paid less taxes? This is where a family management company comes into play. You see, when you have a family management company and place your kids on payroll under the FMC, you are able to shift a portion of your business income to them. In almost every case, your kids are in a much lower tax bracket than you. And if you pay them less than the standard deduction, or $12,400 annually, then they won't have to pay taxes on their income. Plus, you get the tax write-off for the wage you paid them and reduce your tax liability. This is how you can shift income to family members in a lower tax bracket. Diving a little deeper here, an FMC is an entity structure, commonly an LLC, that is established to support the operations of your business by paying your children under 18 for services. If you watched my How to Hire Your Children video, you'll learn all of the benefits of hiring your children while also helping them with building their wealth. An FMC helps to accomplish this, especially if your business is an S corporation or a C corporation. For these specific entity types, you would still have employer tax liabilities, which can make putting your kids on payroll not even worth it. But the workaround here is establishing another business entity to pay them through, and that entity would be the family management company. In most cases, an FMC is simply an LLC that performs services for your main business. So how this would work is by having your S or C corporation pay a management fee to the FMC, and the FMC would pay your children for services they provide to the company. Setting up an FMC is used mostly as a strategy to hire and pay your children tax-free. And the great part about hiring and paying your children is that the wages you pay them can go directly to a Roth IRA, and all of the contributions and earnings accumulate tax-free. No taxes are paid on their wages by you or by them, and can even start earning more in an investment account with no taxes being due if the funds are withdrawn after 59 and a half years old. This is a great way to help your children start saving for retirement tax-free. You can also have their wages go to a 529 plan and save towards college or even K through 12 education expenses. Contributions to a 529 plan grows tax-deferred, and withdrawals are also tax-free if they are used for qualified education expenses. Again, all of which is possible through a family management company. The next reason you may want to consider starting an FMC or family LLC is to reduce your estate taxes and pass on more wealth to your children when you die. I'm sure if you have kids, you want to be able to pass on as much wealth as possible. And this could be to ensure that they have wealth and money to jumpstart their future or propel their goals, whether that be to own a home, pay for education, start a business, or just to help with the care of their kids. One of the greatest marks you can make in your family is leaving behind a legacy and a piece of wealth for future generations. And you can do this by establishing a family LLC. Setting up a family LLC is like setting up a regular LLC and is formed by family members to conduct business. Members in a family LLC must be related by blood, adoption, or marriage. FLLCs allow your adult children or heirs to become shareholders in your business who can benefit from the assets held by the LLC at a much lower tax expense. For example, let's say you have a business and want to pass it down to your children when that time comes. Well, normally, if your children were not already shareholders in the business beforehand, they may have to pay more in taxes based on the overall value of the business. However, if you start making them a shareholder in the FLLC, the taxes due upon your death can be greatly reduced. Here is how you accomplish this. Once your FLLC is established, you can begin transferring assets to the FLLC like cash or property. Or if your business is already an LLC and you don't have any non-family partners, you can transform your LLC to an FLLC. Next, you can transfer a percentage of ownership of the FLLC to your children based on the value of the assets in the FLLC. So if you have $5,000 worth of assets in the FLLC and transferred 20% ownership to your child, that equals $1,000 or 20% of $5,000. However, there are IRS rules which state that the ownership interest of the FLLC is worth up to 40% less than their market value. So the 20% ownership transfer to your children is not really worth $1,000, but more like $600. This is relevant because of the gift tax rules. The current gift tax exclusion is $15,000. So you can give someone up to $15,000 without having to pay gift taxes. This goes for business shares as well. So you can transfer more FLLC shares to your children since the shares are technically worth less and still be under the gift tax exclusion amount of $15,000 per year. As an example, if you have an FLLC with assets valued at $100,000 and want to transfer $20,000 worth of shares to your children, you can do this tax-free since the IRS deems the $20,000 worth of shares to really be worth around $12,000 or 40% less. And you could do this every single year until there aren't any more shares to transfer. Does that make sense? And this, in turn, would reduce the value of your overall estate and reduce the amount of estate taxes that your children or heirs would have to pay, because now you own less of the FLLC because you transferred ownership to them. And remember, the FLLC holds a lot of your assets and wealth since you transferred your assets to it in the beginning. And only your remaining ownership in the FLLC, if any, would be included in your estate tax calculation. Opposed to having all of your assets that you owned in your lifetime being passed down to your children and them paying tax on it because they never owned it previously. Another good part of FLLCs is that parents can maintain management of the FLLC while the children simply just hold shares in the FLLC's assets. And you do this by transferring only non-management shares. So when establishing the FLLC, you can make 95% of the shares non-management shares and 5% management shares. You would hold the 5% management shares and the 95% of non-management shares, and moving forward, you would only transfer the non-management shares to your children during your lifetime. This allows the parents or you to distribute the LLC's assets while the other members or your children are restricted from selling their shares or transferring their shares because they only hold non-management shares. This is good since you can still maintain control and management of the FLLC even as you're transferring shares to your children. Also, there is an estate tax exemption, so keep this in mind if you plan on using FLLCs for estate planning. The third reason to consider an FMC or FLLC is to protect the family's assets against creditors. Similar to normal LLCs, the members of an FLLC all have limited liability, so each family member's contribution to the FLLC limits their debt liability in the company. For example, if you and your sibling come together and form an FLLC and each contribute $1,000 to the FLLC, both of you are only liable for up to $1,000 of company debt if the company itself cannot pay its own debt obligations. This is very important because in a lot of cases, when family members start a business, no LLC is established. And in the worst case scenario, which is a lawsuit against your business, you and your family member would both be personally on the hook for any losses or damages caused by the business. This in turn can diminish not only your wealth and your siblings' wealth from my earlier example, but also can diminish your family's wealth as a whole and limit what can be passed down to younger generations, especially if you have multiple members of your family involved in the business. If a business lawsuit costs your family multiple homes being sold or multiple bank accounts being garnished, this will negatively impact your family's wealth tremendously. This is a very real possibility if an FLLC is not established. So an FLLC is definitely worth looking into when starting a business with your family. And the last reason to consider an FMC or FLLC is to promote entrepreneurship in your family. It's extremely difficult to get far in business by yourself, and some say it's even impossible. Why not involve the people you love most to help you along the way? But not only help you, but to help themselves as well. Having a business is a surefire way to break the income ceiling that most jobs place you under. The income potential of entrepreneurship is infinite. There isn't a cap on the income you can earn. And if you can involve yourself and family in breaking that income ceiling, then you are setting your family up for massive financial success. Plus, we should all know by now that taxes are your biggest expense by far. At least 20 to 40% of your income is going to taxes. And as a CPA, I can tell you, you need to have a business in order to take full legal advantage of the tax system and reduce your taxes. From converting your personal expenses into business expenses to writing off almost everything. Having a business is how you really reduce your tax liabilities. And having a family business will not only reduce your taxes, but theirs as well. This makes keeping more money in your family possible and building generational wealth more of a reality. Now, if you want to start an FMC or FLLC, you would set them up the same way you would any other LLC through the state. The cost, process, and time to establish an FLLC or FMC is the same as a normal LLC. But the strategies behind establishing an FLLC and an FMC are what distinguish them from traditional LLCs. To recap, FLLCs are established if you want to start a family business and protect your family's assets, or if you have adult children and are wanting to pass down your business to them while also limiting the amount of estate taxes that would potentially be due. FMCs are great if you have children under 18 and want to start helping them build wealth while also reducing your tax liability. Please seriously consider consulting an estate or tax planning professional to see if these options are right for you. All right, that's all I have for this video. I hope it was helpful and inspired you to start thinking about how you can create wealth in your family through business. Please let me know in the comments if you have any questions, and I'll see you in the next video.